Hello and welcome to today's webinar, Building Sector Rotation Strategies Through Sentiment Analysis, hosted by Index One in collaboration with BrandLoyalties. I'm Gayatri from Index One, your host for today. We're thrilled to introduce our speakers, Rick David, Chairman and CEO of BrandLoyalties, and Tony Secker, President and COO of BrandLoyalties. Incorporating sentiment analysis into investment portfolios is no longer a luxury but a necessity. These tools provide a deeper understanding of market dynamics and enable analysts and investors to make more informed decisions. Our partners at BrandLoyalties do exactly this. They monitor daily online interest in brand names owned by publicly traded corporations and have developed various strategies based on this sentiment data. So in this session, we will analyze current consumer sentiment patterns and highlight parallels with historical trends, explain how BrandLoyalties collect and analyze sentiment data to create a well-performing index strategy called BrandPower, highlight how the BrandPower strategy differs from traditional sector rotation strategies, along with key considerations when building a sentiment-based sector rotation strategy, and share how Index One supports the calculation and dissemination of the sentiment-based dynamic investment strategy. We'll have time for questions after the presentation, so please submit them in the chat box as they come up. Now, without further delay, let's begin. To kick things off, could you start by giving us a brief overview of BrandLoyalties and the daily sentiment data that you collect?
Good morning, everyone. Thank you for joining the webinar. Thank you, G. Yes, every day the methodology behind the BrandPower Index analyzes millions of online reviews, articles, and social media posts to measure which brands are getting the most attention and traction with the people and businesses actually buying branded goods and services. Each of the over 3,000 US equities that we follow is ranked based on both their brand citation frequencies, we call it the brand luminosity, and how that luminosity correlates with future corporate revenues or the relevancy of the citations. This identifies US-listed mid and large cap companies that are not only popular and generating positive buyer engagement, but are also likely to report growing revenues next quarter. These equity rankings have been provided daily to BrandLoyalties hedge fund clients since 2012. They've been part of MSCI's Factor Lab since 2019 and have now been used to build the BrandPower Index listed at Index One. Each quarter, the BrandPower Index is reallocated and rebalanced to equally weight the 50 equities whose brands have the best combined growth rate and revenue correlation among the companies that BrandLoyalties follows. In addition to powering the material alpha and outstanding Sharpe and Sortino ratios that have been well documented at Index One, having the index mirror the changing public interest in brand names also ultimately beneficially causes the sector weighting in the index to rotate over time. This sector self-rotation in the BrandPower Index is purely quantitative and bottom-up. It starts with finding brands that are gaining or losing the public's interest, which causes the corresponding corporate equities to move into or out of the index's portfolio, thereby changing sector weights in the index even before corporate earnings are reported and automatically rotating into technology, consumer cyclical, and so on, just as that sector begins to get hot.
Thanks, Tony. And this is to Rick and Tony. What are your observations in the current consumer sentiment patterns, and do you see any notable trends when compared to historical data?
Well, taking a look at what was happening during lockdown, you can see from the pie chart that at that time, consumer durables, non-discretionaries, were much larger than the consumer cyclical, which is the discretionary items. And in general, the consumer interest was tamped down relative to the rest of the sectors. And for that reason, the weighting that we had in the index itself during lockdown reflects that. We just had very, very few consumer discretionary, more consumer staples, but the bulk of the index was in healthcare, energy, materials, the kinds of things that aren't dependent on consumers. If we can go to the next slide, immediately post lockdown, you can see that the consumer discretionary sector, the consumer cyclical, just expanded. The part that was just at, or the pie segment that was at 2 o'clock in the during lockdown, had expanded to cover a time from 1:30 until 4. if you're looking at the pie chart, and it's just a tremendous expansion in consumer cyclicals in the index. Now, why was that? It was nothing. I mean, we're not sitting in an ivory tower looking at economic reports and saying, let's overweight consumer cyclicals. It happens automatically as a result of the brands that we see being mentioned on the web just change from the brands reflected by healthcare or by consumer staples into the things that are more discretionary, dining, recreational, those kinds of things. And that was an indication that coming out of lockdown, the consumer sector was going to explode, and it was going to explode in all the things that had been suppressed essentially during lockdowns. If we can go to the next slide, what's interesting right now, we're looking at U.S. equities, and most of the sources that we have for those are U.S. consumers. And right now, U.S. consumers, as you can see, the consumer cyclical and the consumer staples have just shrunk to practically nothing. And in fact, that those pie charts were zero in at least the consumer cyclical. I boosted the value a little bit so the slice would show up in the pie chart. But right now, consumers are as much depressed or more so depressed about the economic situation than they were during lockdown. The difference being that during lockdown, everybody had a feeling, well, yes, this is bad, but it's going to end pretty soon. Whereas during the third quarter of 2025, consumers don't necessarily see the light at the end of the tunnel. So that's an indication that our index has rotated automatically. Nothing we've done, nothing we've sat back, with feet up on a desk and pipe in the mouth and deciding that this is the sector that we want to rotate into. The index does it, and it does it before we actually have any idea what's going on. We can go to the next. Yes, this is an indication of what the consumer cyclical sector was actually doing on a quarter-by-quarter basis. This is the absolute weighting of that particular sector in the index starting in 2010 and going through the third and now into the fourth quarter of 2025. And you can see that it varied. In fact, coming out of the Great Recession, 2010, 2011, when consumers were just going crazy spending, you can see that it was making up more than 50%, well more than 50% of the index at that particular point in time. And it stabilizes, it drops down, and it's moving along, chugging along somewhere between, let's say 15, 20%, sometimes a little bit below 10%. But now the next chart shows you how if we add in technology and healthcare, we can see that how the sectors that are reflected in the brand power shift and rotate over time. And again, this is nothing that we're doing consciously. It's just kind of a natural fallout of tracking what consumers are interested in, what brands they're mentioning. We map those brands to the equities, and the consequence is that those equities will be either included or excluded from the index, and that changes the weighting in the index. And if I showed all 15 sectors, this chart would be unreadable. But it's basically there's always a shifting and a moving from one sector to another. One gets overweighted, one gets less weighted. Okay.
Thanks, Rick. Yeah, so that was pretty much going to be my next question, is to kind of go through the thought process behind constructing the index and explain how the sentiment data informs the sector weightings, because you created the BrandPower Index that's based off of this sentiment data, which is what determines the weightings. Could you also kind of go into how the BrandPower Index differs from a traditional sector rotation strategy?
Well, one of the advantages, and one that Tony likes to mention, is that we're not concentrated. We're not driven by rotating from this sector to the next. We're actually moving from one equity to another based on how popular it is. And the consequence is that this results in a cross-sector precision approach, if you will, targeting the individual stocks, generating the strongest online interest and brand visibility, so that again, not a conscious decision to move into automotives or to move into recreational equities. It just happens automatically, or as my daughter used to say, automagically. It moves from one sector to another, and it causes that weighting to change. But that's beneficial, and it's kind of collateral benefit to working from the bottom up. And it casts a wide net. I mean, we're not when we're looking at the over 3,000 equities represented. We've got over 700 equities that have been in and out of the index over time, and they represent the highly liquid indexes that are really active among the top 3,000 in the United States. So and we're basing this on where public interest is changing, and because it just rotates only the top performing stocks into the index, and it stays agile, and it captures the leadership whenever and wherever it emerges, and probably in some cases before the results are even published by the affected corporations.
Thanks, Rick. And for our viewers, how does a strategy like BrandPower fit into an investment portfolio, and how can investors leverage this strategy? And also, does it have a potential role in managing risk and volatility?
Well, one of the points that we're making is that it's a potential core holding in investment portfolios. There is no such thing as a buy and hold investment of any kind, but this is something that can be bought and held quarter over quarter, because it will be responding to what's happening in the among consumers, and what's happening really with the revenues of the corporations moving forward. So that it's not suitable for day trading. It's not chasing after rumors. It's not looking for that next big thing that the talking heads on investment or directed TV might have their pundits suggesting, oh, we think it's time to move into this or whatever. All of our analysis indicates something. we're not doing analysis other than counting citations that are being made by the people who are actually buying products, citations of brand names. But by doing that and noticing who's active and noticing whether that activity on the web translates to revenue changes with the corporations, this is the we're talking about luminosity and relevancy. The relevancy is a correlation between the luminosity and revenue. If we pay attention to those, it moves the portfolio in a way that makes it safe as a core investment and makes it safe for the people that are self-directing their 401ks or their investment portfolios at places like Schwab or Fidelity, and it allows them to self-direct their accounts, even if they're not following slavishly following the account on a day-by-day or hour-by-hour basis, but maybe only looking at it every couple months or on a quarterly basis to see what's actually changed.
Amazing. Thank you so much, Rick. Okay, so when it comes to Index One, we continue to come across innovative strategies like the BrandPower Index, and we have the honor of calculating these indices with a high degree of flexibility and accuracy. BrandLoyalties were able to set these indices up independently using our all-in-one indexing calculation platform. They essentially signed up, uploaded a CSV file of the strategies, weights, and constituents, and now rebalance the strategies on a quarterly basis using our rebalance and corporate action capabilities. And while we work closely with clients when setting up their indices, our goal is for the platform to function on a self-sign-up basis. So we're very pleased that BrandLoyalties are finding value in using our indexing platform, and we truly appreciate and cherish our partnership. And we look forward to seeing more indices from BrandLoyalties in the future, and we're proud to serve as the index calculation agent for their very innovative strategy products and launches. And to our audience, if you have any questions, please feel free to submit your questions in the chat box. I see that we've got one question from Rakesh. Hi, Rakesh. Is there an investable product like an ETF for this?
Right now, we have the product on a direct indexing platform, and if you want the details, we can do an introduction. If you're interested to that particular platform, you could just email Tony, and we'll get an introduction so you can see it. We're certainly looking for the ability to turn around and say there's an ETF that uses this, and we're working to get something along those lines in place. But at this point in time, no, there's nothing that you can do other than to use a direct indexing approach.
Amazing. Yes, we will connect you to Rakesh because he is looking for more information. Thank you so much, Rakesh. Great. While we wait for more questions, Tony, how do you know if a specific brand mention online is favorable or unfavorable for the brand?
Yeah, that's a good question. We don't actually parse each individual mention for sentiment. Excuse me. That can be very noisy and subjective. Instead, our approach is completely systematic. We track citation market share, as we've mentioned, essentially how often a brand is being referenced online relative to its peers. And we let those trends dictate positioning rather than our opinion. That change in citation share determines what we call the brand's luminosity, as you've heard us mention. A consistent rise in luminosity usually indicates a growing market attention and engagement, regardless of whether each mention is framed positively or negatively. To protect against anomalies, if we see a sudden several sigma spike in citations, well beyond the brand or company name's normal range, we'll flag that event for our clients. Now, it could represent a viral moment, maybe a PR issue or a structural shift in awareness, but the key is that our data responds to what the market is doing, not what we think about it. That's why we believe that it tends to be more consistent and reliable than traditional sentiment analysis. Back to you, G.
Thanks, Tony. Rick, why does the index have 50 constituents? Couldn't you have gotten better performance with lesser tickers, like 25 or even 10 tickers?
It's just coming up with something that is manageable in a direct indexing environment. That was one of our original targets. It could be larger, it could be smaller. We have modeled both ways. We end up with the best Sharpe and Sortino ratios. In fact, if the portfolio has somewhere in the neighborhood of 50, it's an arbitrary limit. If someone wants a custom index with 75 or 100 components, we can do that. If you want to go to 25, it'll be noisier, but we can certainly do that as well. So figure that 50 is an arbitrary number, but it is one that works and has been comfortable and gives us really good Sortino ratios in particular.
Thanks, Rick. And my next question was actually going to be about why the positions in the index are equally weighted instead of a market cap weighted scheme. But we just got a question in from Abe Adami. Hello. He says, good day, apologies, I missed the first 10 minutes. If you could briefly summarize whether this would be the sentiment weighting of companies versus the regular cap weighted ones. So if either of you could just quickly summarize what the index is and how it's been weighted and why it's been weighted equally, that would be great.
Well, the equal weighting is fundamentally driven by the fact that our data is equally weighted. We start out in a citation from a mid cap. We rate that and weight that exactly like we would one from Google or Apple or Microsoft, so that our data is fundamentally equally weighted. When we're taking that and moving it forward to allocating and reallocating in the index, we have always felt it's important to recognize that we're not taking an Apple or a Google or a Tesla citation and weighting it at 1,000 times more than any other company that we're looking at. So it made no sense to do market weighting in the actual index. I would also say that there's a strong possibility that some of the outperformance that we've seen is directly related to the fact that it's equally weighted, and there are certainly some studies that have been made that would indicate that you can get additional performance by equally weighting. There are times that using market weighting would probably be advantageous, and perhaps now is one of those times. But our data, is fundamentally equally weighted. Each citation comes in with the same weight as any other, despite the capitalization of the company that owns that brand.
Amazing. Thanks, Rick. Yeah, we can definitely connect you to Abe Adami as well. I think he would like more information on the index, so we can do that after the webinar. I guess my final question is, do you track brands of equities listed outside of the US? And if so, what regions are they?
I'll take that one. Yes, absolutely. We offer different subscription packages based on regional coverage. So in addition to US listed equities, which we've been primarily talking about here, we also track brands across Europe and Asia. To make sure our global data is accurate, however, we work with linguists from multiple countries and they help to identify the most relevant brand names and local variations in several languages. So even so, everything we produce runs on the same analytical engine. The exact same process and methodology are applied everywhere. We also don't really rely on third-party providers to produce our data. So that combination of consistency and independence makes our data set very compliance friendly. And we think it especially appeals to systematic quants. I think that they appreciate that our signals are consistent and scalable around the world, built on one unified framework and completely independent of outside data sources. G?
Thanks, Tony. Amazing. I think that's all the questions that we've got for today. So thank you everyone for your questions. And if you'd like to get in touch with any of the speakers today, you can reach me at index1 at index1.io and Rick and Tony at brandloyalties.com. And we'll obviously connect with the people that ask questions separately. You can find the BrandPower Index on the Index One and the BrandLoyalties websites. Again, if you have any questions, please feel free to reach out to us. Thank you all once again for your time and participation, and we look forward to seeing you at our next webinar. Thanks, everyone.
Thank you.
Thank you.